Hey, what's going on, investing family? I'm Stock Market Jay. I'm here to say today, bringing you some news you can really use. All right, guys. So first and foremost, what I wanted to do is give a cool breakdown on the Chipotle stock split and what this means for you, the investors, the pitfalls of it, what to look for, and basically what to stay away from. Because just because the stock is selling cheaper doesn't mean it's affordable to own. Right. So basically so what happens is they did the stock split. It's a 50-for-1 split, which means that you get 49 shares for each one share that you own. So what they ended up diluting the shares. They added more shares to the overall shares that they had. It increased vastly, which usually makes the stock less valuable. Okay. The buying back shares increases value, diluting them decreases value. Here's the thing, though. They did this because the stock was trading at $3,000. You have a $3,000 ticket price on the stock, but now it's trading at 62, making it more accessible to the everyday investor, to the retail investor, the average person, right? It is accessible to you, but by the metrics, this stock is still very expensive to own. On a price to sale basis, it's going to be an 8 price to sales ratio, a 66 on a price to earnings ratio, and then a 26 on a price to book ratio. These metrics suggest that this stock is very overvalued and inflated. Okay, so from a value perspective, would I own this stock? No, just from that metric alone. Here's the thing. A growth investor might want to own this stock because of the fundamentals of the business. Fundamentally, this business is sound. You have $1 billion in cash, which is 44% increase over the last year, 14% increase in revenue. You have $4 billion in debt, but the debt to equity ratio is 1.5, which is healthy for a business overall. $8 billion in assets. So overall, the business is in fundamentally sound health. They are growing the business. They're growing those metrics that you want to see grown. They're maneuvering in a way in which they're expanding their multinational footprint. They're gaining market share. Their earnings per share over the last 3 years, the EPS has increased 127%. They're growing the business fundamentally. They are financially sound. They are fundamentally sound, systematically run businesses. They are run very well. They have a great management team. However, like I said, when it comes to the ratios and how affordable this stock is, like I said, just because it's accessible in price, because it's not $3,000 like it was at first, doesn't mean that it's cheap to own this price. You're paying for the company's earnings, you're paying for the company's sales, and you're paying for the overall book value. You have to understand that as an investor. So would I own this stock? From a value perspective, no. Would I own it from a growth perspective? Yes. It has tremendous growth, a run rate of growth ahead of it. They're increasing revenues, they're increasing earnings. It's a phenomenal business. But would I buy it as a value investor? No, I would not. It's overvalued. The stock is inflated. It would have to come down to at least $40, maybe $30 before I even consider buying it at this valuation right here. All right, investing family. Peace.